Good afternoon, ladies and gentlemen, and welcome to the PELATRO PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will notify you by email when these are ready for your review. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'll now like to hand you over to CEO Sebastian Menon and CFO Nick Hellier. Good afternoon.
Hello. Hi, good evening. Thanks everybody for joining this session. I will take you through a couple of slides and then I'll hand you over to my colleague Nick, who's a CFO. For those who do not know me, I'm the co-founder, CEO, and managing director of PELATRO. We are presenting the full year results for 2021. My background has been in software for over almost 30 years, having founded another company initially and then subsequently exited that business in 2012, co-founded PELATRO in 2013, and has been building that ever since. Nick, you want to quickly introduce yourself?
Sure, thanks, Sebastian. My background pre-PELATRO was in investment banking, where I focused on the small cap sector as a generalist, both raising money for companies as well as getting involved in various M&A. I've been with PELATRO since before the float. We floated at the end of 2017, and here we are, 2022, nearly 5 years later.
Thanks, Nick. This is a very, very important point that we would like to make. PELATRO has been selected as a 2022 Company of the Year for Asia Pacific Contextual Marketing Solutions for Telecom for excellence in best practices. So essentially, they evaluated our product, the kinds of features and functionalities the product has, the applicability of it to the telecom industry, the kind of customers we have, and the feedback from the telco customers of ours on the product and how happy they are with PELATRO, etc. So a variety of aspects were brought together to evaluate various companies, and finally, in our space, they chose PELATRO as the Company of the Year for 2022. So that's a huge recognition, and that's definitely adding a lot of credibility to the company, and it's helping us with our customers as well. That takes me to I'll go to the next slide. So these are some financial, headline information. Nick will give you more details later. I will just touch upon the revenue at this point in time, the kind of growth we had. It's $7.27 million is a revenue that we got to in 2021. As some of you may remember, at the beginning of the year, our guidance was 7 million. Then along the way, somewhere during mid-year or something like that, we increased it to 7.2, and finally we ended up with 7.27 million. So and we had also indicated sometime in July-August timeframe that we now have full visibility for the full year. So this whole visibility concept from us, when we say we have got so much visibility, that means we've got contracts in hand to execute that revenue, and so that means that revenue will certainly happen. So so when we give you a visibility number, you can take that as revenue cast in stone for that particular year. And given the kind of given the quality of our contracts, the nature of our contracts, predictability is very high, visibility is very high. Recurring revenue $4.79 million as against 2.85 last year or the year before, and recurring and repeating 6.75. So in all, 93% of our revenue came from recurring and repeating. Now, repeating is also is almost like recurring for us in a way, because it will repeat every year. That's an absolutely essential thing for our customers. That's why they keep repeating those contracts, those requirements with us. So this means that every year, with every passing year, we start the new. We keep increasing the base, and the new year is started with a new base. So if you look at that recurring and repeating 6.75, so that's a minimum number for next year, as in 22. So we started the year 22 with that 6.75 in the bag. So that and by the time we end 2022, that'll be a higher number, and that will become the starting point for next year. So this is a very nice way of building a base as we move forward. Adjusted EBITDA came to $2.81 million, a significant growth, 39% adjusted EBITDA, and as against 11% last year. We had said that, given COVID and all of that, our number of customers that we would sign up in the year will be a little lesser than a normal year. And we had said it'll be 2 or 3. We actually ended up adding 3, and now we've got 23 customers. In 22, which is a regular year, we will naturally add more. We should probably add 5 or 6 customers this year. But in 21, we added 3 because of the effect of COVID, which was still there during the year. So those are the top line numbers for you. And just touching upon the post period and highlights, pipeline for telco business at about $17 million. It's going quite strong. This is adequate for our growth. We have been talking to you about non-telco business. Last time we told you that we will not have a non-telco business revenue in 21, and of course that did not happen. We had told you that in 22 we will have non-telco business revenue, and that is now starting to happen. We are starting to build a pipeline in the non-telco space, so we are absolutely confident of having some non-telco revenue in 2022. So by the time the year is out, PELATRO will be in telco as well as non-telco business. Now that's a huge growth area for us, non-telco, and we hope to build on that on the start that we will have in 22. We hope to build on that in the years to come. We're very excited with the possibility, and we're sure that will really add a lot more growth to what we would, what we could otherwise have, with just the telco business. That takes me to the core financials, and I would like to hand you over to Nick at this point in time.
Thanks, Subhash. Hopefully everyone can read that. Let's just unpick some of those numbers. And there's one question which was pre-submitted, which I'll try to cover in the course of doing that rather than coming back to at the end, because I think it probably is covered by that. So if we look at the revenue, clearly top line revenue grew from the $4 million in 2020 to 7.3 in 2021. 2020 for us was very much the year of transition, where we were focusing or had started our focus on gaining recurring revenue, and you can see that in the results. So I've just put the recurring, repeating, and other revenue down in detail on that P&L. So obviously straying away from the statutory format, just so you can see that clearly 2.9 has grown to 4.8, which is great for us. Within that, the vast majority of that growth has come from managed services. So what is in recurring? It's managed services, it's our annual maintenance contract or support, and it's some gain share as well. So within that, it's the managed services which has driven that growth, which is great for us. Repeating revenue, for those of you who are not so familiar with the company, the repeating revenue is change requests. That generally comes from people with licenses who come back to us and ask us for additional functionality, features, whatever, and we process those changes for them as a change request. Actually, the change request eventually we only do it if it's actually going to add to the software generally, and eventually gets wrapped up in further versions of the software. So the software over time doesn't diverge, it actually comes back to a common ground. But we charge our customers for doing that. And again, 2020 was probably a low year because a lot of it was affected by COVID in terms of the actual execution of that, which is unusual, but that's how that was. Mainly at the customer end, not so much at our end. It was at the fact that there weren't people at the customer end to be able to do the necessary implementation steps for us. So that grew significantly to just under $2 million, which was very pleasing. The other, that includes license income, which, as you can see, has actually gone down slightly. License income, we will still very happily sell people licenses if that's what they want to buy. So that's in there, but as you can see, it's a much smaller proportion of the revenue mix now than it has been historically. And so clearly, we're not a wholly recurring revenue company, but we are very well on the way to having got the majority. Well, we have got the majority of our revenue coming now from recurring revenue streams. Concentration is something which is often comes up as a question. Within that $7.3 million, there are only 2 customers now out of the 23 who are more than 10% of that revenue. One is about 1.6 million, one is about 1.3 or so. Then there's a cluster half a dozen or so at around the 500 to 750 mark. And then there's a tail of smaller customers. So concentration, again, has gone down. So that gives us some comfort over the revenue mix. Ditto geographical concentration has reduced as well. This is where we come to the costs, which someone has asked a question. Can you explain the increase in staff costs in the results? And they've also asked about the increase in the overall admin expenses. So part of that staff cost is, I can answer by just touching on the cost of provision. That's cost of sales in layman's language, if you like. That is not entirely, but the vast bulk of that is the cost of people actually delivering managed services contracts. There's and the support as well. So obviously we have people doing support, we have people producing managed services. That cost is in there. There's one or two other bits in there as well, some sales commissions, things like that. But by and large, the majority of that is cost of people. So one of the big factors within the increase, which you can see in cost of provision going from 1.7 in 20 to 2.2 in 21, is the people running the Vodafone contract. Now, we've talked to people before about the big Vodafone contract we've got in India, which is a 5-year managed services contract. That was only started in 2020, I think July or so, or roughly half a year. So there was half a year of cost, obviously only half a year of income in 2020. We've got a full year of cost in 2021 because it was fully up and running. So that's a large part of that increase. It is just literally bums on seats of people producing the actual services. If we then turn to overheads, so that's part of the staff cost answer. Obviously, there are some staff in overheads as well as other things. So that's a 20% increase. Now, that's due to all sorts of things. I mean, firstly, yes, have we got one or two more people in the overhead section as opposed to the cost of provision section? Yes, we have. Not a significant number. You know, it's a handful. We've taken on people in marketing, sales as well. Obviously, there's some non-telco sales people in there, and so on and so forth. Also, yes, has there been cost inflation? Most of our people are in India, and that is a competitive environment from an employment perspective. So there is cost inflation there. So that's in there. So that's where the bulk of the staff costs are. So that's, I think, hopefully answers the staff cost question. Unhelpfully, on the statutory P&L, it's all lumped into admin expenses. So staff cost, obviously, that's a cash cost, but admin expenses on the statutory P&L also includes the non-cash depreciation and amortization, which has gone up quite significantly for two reasons. Firstly, depreciation, again, going back to the Vodafone contract, when we started implementing that, we put in a pretty significant amount of hardware, about $900,000 worth of hardware to run that. That is obviously being depreciated, so that part of the a large part of the depreciation increase has come from the full year effect of that hardware being depreciated. Amortization has gone from I forget the exact numbers now, 2.1 million in 2020 to about 2.8 million in 2021. That's on our software base. We capitalize the cost of developing our software as we're required to by the accounting standards. That obviously gets amortized over 4 years, which is actually a pretty prudent amortization. If you look at other companies, they often do it over longer. And clearly that's catching up. The more we spend, the more eventually we'll get washed through the P&L in terms of amortization. So that's a pretty large chunk. I think if you just look at the admin expenses as presented on a statutory basis, that's probably the bulk of the increase comes from those two factors: amortization, depreciation, and some staff cost as well, which has gone through the overhead line. So hopefully that answers that. So all of that clearly a lot less than the increase in revenue. So hence the EBITDA number has gone from $400,000 to the 2.8 in 2021, which is obviously that's the direction we want to be going in. Just quickly going down through the rest of the P&L, I've talked about the amortization. That's you can see that coming in there. That's the pre-acquisition number. Acquisition later on. The rest, there are no exceptionals this year. There was an exceptional in 2020 relating to our acquisition, but that's all gone now. Tax, there are a lot of moving parts, as you'd imagine, in our tax comp, because we're a complicated global business with different tax exposures in different jurisdictions. That's actually gone down largely due to a bit of a tax credit, which is nice, in the UK topco, which we're actually getting in cash hopefully later on this year, which is obviously good news. So that has led to the net result, which is significantly up in 2021. So if I take you through to the balance sheet, I'll try and spend a little less time on the balance sheet, but I was answering a question which came up. You can see the software assets there have gone from just under 6 million to 6.5 million in round numbers. That's, as I say, that's the net of the spend on it, which was about $2.6 million this year, less the amortization, which is catching up with it. And obviously, we'll continue to spend on it, but it's catching up. Nothing else of particular note on the balance sheet other than trade receivables. We always get asked questions about our trade receivables, which, if you look at the number, looks large, especially in comparison to the revenue. I think I would caution against doing a simple debtor days calculation, because it's mixing a lot of different numbers on the debtor side, different types of debtors, different license sales, recurring revenue sales, all of that, with different P&L items. What I've done there is I've just stripped out a couple of skew factors, if you like, and I don't do it lightly. I adjusted it so people could see the underlying trend, and giving you a sort of again, I hesitate to call it clean, but a cleaner debtor day figure, which is more in line with what we'd expect given the nature of our business and the sector we deal with. Just why have I stripped those two items out? One was just under $700,000, where we do deal with jurisdictions where there's often exchange controls and other processes that the customer has to go through to pay us. They always lead to delay on a good day. Sometimes things can go out of everyone's control. And in this particular situation, what happened was the local government process changed, which meant that a whole load of stuff got backed up beyond even the normal delay. We had confidently expected those to arrive last year, in which case obviously the debtors will be less by $700,000, as would the cash flow be more. They didn't. I won't bore everyone with a long story, but that's finally got sorted out, and now the process should be a lot smoother, and those payments are finally unlocking. But that's stuff we deal with every day. That's not we expect the unexpected in that sense, and that was just something which caught us. There was another big debtor in there which relates to a license sale, or license completion rather, which has again skewed the debtor balance, which if you take that out, as I say, that gives you a cleaner number. And we get those numbers in, we've got cash coming in from that. And just to reiterate, in the 5 years we've had of longer than 5 years of operation, we have never had a bad debt. So that would be our expectation looking forward. Just very briefly on the rest of the balance sheet, borrowings have gone down. We raised money last year, as you might know. We used some of that for repayment of borrowings, so that's come down. That was in July, or I think we actually repaid it in August or September. So the P&L effect of that it will be felt on a full year basis this year. So that's the P&L. Just very briefly on the cash flow. Again, I've represented that to hopefully draw out a few, again, unusual skew factors, if you like, which obscure the underlying trend. 2020 actually in operating cash was a pretty good year. 2021 on the face of it looks less good, but let me just talk you through some, as I say, those skew factors. We did actually pay out in cash some very chunky, and I use the word not in the accounting sense, but the literal sense, exceptional commission payments. Now, step back a little bit. We do use commission agents. We do have to pay them. And we have to pay them on the total value of the contract. And that largely reflects, that large number reflects the fact that it was the big contract, managed services contract, which I've talked about, which we won, which the total value of that was pretty large, and therefore the commission payment was equally pretty large. We had provided for that as a creditor at the end of 2020. We paid it in 2021. So that's what's affected that cash flow from operating activities. If you add that back, that probably gives you a rather fairer picture of the cash flow than you might otherwise get from the statutory presentation. And you can add back the debtors skew factors if you like. I haven't done that, so I don't want to stretch the point, but you can do that if you like mentally. You can see the income from the share issue coming in there as well. So that left us with $3.3 million on the balance sheet at the year end, which was obviously that gives us a strong position to go forward. We certainly don't need cash for operating activities looking forward. Touching briefly on current trading, we have to switch Nomad to broker to FinCap, but they haven't produced a note yet. That said, the Senkos forecast is still valid in our mind. They had $9 million out there. So as Sebastian said at the beginning, that revenue visibility that we gain through the nature of our contracts is 7 million or already. The large chunk of that is recurring revenue, so that gives us continuing momentum on that front. And we expect to add 5 or 6 new customers this year. We only did 3 last year, which, as Sebastian said, was very much COVID affected. This year, obviously, it's reasonably back to normal, so we expect to add 5 or 6, and we're already in the contract stage for 3 of them. And importantly, the non-telco business pipeline is getting built. We've talked to a lot of different people, and now we're actually focusing down on probably it is the financial services sector where we'd expect the first revenue to come this year. So I'll pause there and just quickly look through these questions which have been coming in case any are for me. Employees, we've got about a short 250, including contractors. They're not necessarily all people directly employed by us. And yes, those will scale. Now, that scales in different ways. If we take on a big managed services contract, we will need people to actually deliver that contract. So that's one form. That's a direct cost of that contract. Do we scale with more developers who are, if you like, sort of working on the software generally? Yes, but it's single digits of people, or maybe just into double, and not. And for example, on Vodafone, we've got 50 plus people working on that. So in the unlikely event, if we got a contract the size of Vodafone again, we'd have to go and hire another 50 or 60 people to deliver it. Now, that would be unusual, but that's the sort of scale you're talking about. I'll pick up the Nomad one as well. Yes, we have ended up where we started. That was for all sorts of reasons. You can look at the share price when Senkos joined and when they left. That might give you some clues as to why we weren't particularly happy with them. We went to them for a specific reason, notably the first fundraise we did back in 2019, but we felt it was right to go back to FinCap to do that. The rest, I think, are probably for Sebash, unless he tells me otherwise. So I'll pause there and let Sebash pick up any other questions.
Sebastian, Nick, if I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Sebastian, as you can see, we've had a number of questions, and I will shortly invite you to open up that Q&A tab. But perhaps for doing so, ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated in the right-hand corner of your screen. But just while Sebastian takes a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Sebastian, if I could just hand back to you to run through that Q&A tab, and where appropriate to do so, if you could please
just
read
while
out
Sebastian's thinking as well, I can probably pick up, which I misread. How are you remunerated? I think that's how do we gain revenue? So we have 3 key revenue models, which is, one is the license model, which is we just sell the customer a license and they get on with it. I mean, that's obviously simplifying hugely, but it's if you like it's not a one-off. The license fee, if you like, is a one-off, but then we have support which follows that, and more importantly, we have change requests, which are actually over time probably equally, if not more, remunerative. So that's a number. The other model is the managed services model, which is obviously what we're focusing on now, which is a recurring revenue model, which gives us much greater visibility. So clearly, we prefer that. The third model is, and this question alludes to it, the gain share model. Now, that's actually a relatively small, by dollar terms, component of our revenue. We have some, not many, some pure gain share contracts, which is where we are paid on performance. So the software is used, we calculate a gain that the customer enjoys by using the software, and we take a percentage of that gain, 10 or 15%, something like that. But that's a relatively small number. What is actually more common now is a mixture where we have a managed services contract where we deliver if you like, a sort of base level of performance, and then over and above that, we take a share of incremental gains to whatever percentage. So there's a whole mix of models. You can see the split on the face of the P&L, which I presented and just talked through there. So that hopefully will answer that question.
Okay. So can I get going with my...
Yes, sir, please do.
Yes, I've actually taken on them.
Okay. So there's a question from Mark. Who are your main competitors, and what do you feel are the key reasons and why the MViva platform is chosen by telcos above others? There are two types of competitors at this point in time. One is all the large players like an IBM or a Pega or a SAS or somebody like that. Then there are smaller players like Pelatro, like an Evolving Systems or a Flytex or somebody like that. So in all, we come across about eight to 10 competitors. There are two fundamental reasons why we are able to gain over them and replace them in various telcos. First and foremost is the capability of the product, the features and functionalities, and the deep domain expertise that Pelatro has in the space. So when a customer sees our product, they can clearly see the differentiation. They can clearly see how they can benefit more from the platform as compared to what the competition is doing. So on the product side, so pretty much in any RFP, in any tender, when we participate, we get technically rated as the best. Technically the best. We get rated like that. So product-wise, we will win hands down. So that's one big thing. The second thing is the level of support. I've been in the space for about 25 odd years. So I know the value of support, and I know how that should be leveraged as a strength. So on the support side, we really, really support our customers quite extensively. So the users, the customers are very happy with the product, the way the product evolves over time. So we never let it become obsolete. We're always ahead of the curve. And they're very happy with the level of support, because in technology, things do break down. I mean, problems do happen. I mean, so there are always issues. And then it's the attitude and the nature of the company as to how they address those issues. So that's where we score over our competition. So between the two, I think we end up being, we've got excellent reputation in the market, and that is really what's helping us win customers. The next question is, how many employees do you have, and how do you see the scaling to meet demand? Okay, we have a little short of 250 employees at this point in time, and we have reached non-linearity at this point in time. So if revenue has to double, the people need not double. So I would think that our margins will keep improving over time, which means the cost will go up in a lesser manner as compared to the revenue going up. But scaling this up is, we're not talking about huge numbers, right? So on an annual basis, we'll probably have to add 25, 30 people, maybe 40 people at most, which is quite manageable. So that's for the growth. Do you have exposure to issue? No, we don't have any business in Ukraine. We don't have any employees, customers, nothing in Ukraine. Could you explain the Nomad? What is that?
I did that one too, Ash.
Sorry?
I picked up the Nomad one already.
Okay, so you handled it.
Yeah.
Okay, all right. Please be more considerate towards shareholders who would truly appreciate more frequent news flow. So news flow is a function of when things happen, right? So it's not as if we are not sending out news as and when it happens. We will send out as and when it happens. So it's just a function of what's happening when. So we're not artificially controlling news flow. Let me put it that way. How are you remunerated? Is it fee based? So that's addressed, right, Nick? Yeah. What's happening with Banix Acquisition Corp? How do you see lack of action there? When can we see? Banix Acquisition Corp has got nothing to do with Pelatro, so I don't know what the relevance is. It is a SPAC which is looking for acquisitions, is all I can say at this point in time. Subhash, looking at business fundamentals only, could you please share your thoughts on why the market cap has gone down significantly? How do I answer that question? From a business perspective, as I can see, things have only gone better. So in 2019 and 2020, we repeatedly stated that we are changing our revenue model from license to recurring revenue, which is a much better revenue model. And that is why our revenue is going down in 2020. I'm not sure if anybody heard that, but we repeated it multiple times. So the sole reason why our revenue went down was that. It was not even COVID. It was not anything else. It was the sole reason was that. But probably nobody paid attention. And as we have been vindicated, we now stand vindicated. In 2021, we had said it will come back up, and it has come back up. So we are now at 7 million odd revenue, And in 22, we'll have further growth. I mean, 20 odd percent, or whatever that percentage is, we'll have that sort of a growth in 22. So the business never really did poorly. People thought the business was doing poorly. The business never did poorly. The business only went through, it morphed from one type of revenue model to another type of revenue model. And as we all know, whenever chunky license revenues are replaced by more steady, smaller per month recurring revenue, your revenue drops. That's all that happened. So fundamentally, things only improved. They didn't go worse. But for some reason, unfortunately, the shareholders did not seem to have got it, is all I can say. I don't know whether there are other issues there. But fundamentally, things were just fine. Can you talk through your advertising scheme? Okay, fine. This is the non-telco business that we are talking about. We like to call it non-telco business, actually. In the non-telco world, I mean, it looks like advertising and all that, and we have used the term in the past, I know, but it's actually non-telco business. We have started building a pipeline, as you've heard, and we are absolutely certain of having some revenue in 2022. Yes, we believe over the next few years. The 15 million was not for this year, by the way. Over the next few years, which is what we had indicated, we still believe that there could be good growth in that business. Would you still say that incumbent traditional providers have not caught up on? If you're referring to vendors, absolutely yes. That's why we are able to replace them. If you're referring to telcos, yes, there is still a long way to go for them to catch up as well. I'm not quite sure whom you mean by providers, maybe vendors, maybe the telcos. So for both of them, yes, there's catching up to do. And on the vendor side, I don't see that happening at all, which is good news for us. And that enables us to maintain our lead over them. Could you please add more color to the fact that you consistently rank above your competitors on technical parameters? One you said is technical support. No. That technical support is not the reason why we rank above on technical parameters. It's basically the features and functionalities of the product, the design of the product, the architecture of the product, the ability of the product to handle things in real time, the artificial intelligence and machine learning capabilities of the product. Those are the things. Of course, technical support is a factor, no doubt about it, but that's probably like 5% when you do a technical evaluation. That will come later when you look at the ranking with respect to various other parameters, including reputation and all that. So the technical evaluation basically is about features, functionalities, capabilities, and all of that, which I think I've just answered. How many analysts are currently covering? I except for our home broker, I don't think anybody. Approximately what's the institutional coverage in PELATRO? Institutional coverage is probably in the region of about 20 odd percent. I would think 20 to 25%. I think I've answered all the questions that have come that are there till now.
Absolutely. Subhash, Nick, thank you very much indeed for taking the time to address all of those questions that came through from investors this afternoon. And of course, if there are any further questions submitted today, we'll make these available to you immediately after the presentation has ended and for your review. And ladies and gentlemen, we'll publish these responses where it's appropriate to do so on the Investor Meet company platform. Subhash, perhaps you're redirecting the investors on the call to provide you with their feedback, which I know is particularly important to yourself and the company. If I could please just ask you for a few closing comments to wrap up with, that would be great.
Okay, thank you. So I will go back to one of the questions which was asked as to fundamentally, how things went. 2021 went exactly as per plan. We said our revenue will come back up. We said it will be 7 million initially, then we said 7.2. We did that. We said we will win 2 to 3 customers. We did. We won 3. 2022, as we speak, is also going to plan. We have a $9 million revenue number there. We will meet it. We have said we will win 5 or 6 new customers. Out of that, 3 are in contracting stage as we speak, and will be closed by June. And another 2 or 3 will definitely come through in the second half of 2022. So 2022 is also going to plan. So fundamentally, as I said earlier, over the past few years, the business has grown. It has done better. It has better foundation, a much better foundation. Now, given that we've got a lot of revenue coming from recurring and also repeating. So if you look at the company that went public in 2017, and if you look at the company today, it's a completely different beast. It's a much higher quality business at this point in time. And that's the truth about the fundamentals. That's what I would like to share with you. We will continue to grow. We will continue to deliver what we have been promising. Thank you very much.
Thank you very much for that, Subhash. That's great. And Nick as well, thank you very much indeed for taking the time to update investors this afternoon. Could I please ask
Thank you.
investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of PELATRO PLC, we would like to thank you for attending today's presentation. That now concludes today's session. So good afternoon to you all.
Thanks, everybody.
Thank you.
Thanks, Jake. Bye.